The Nifty is up almost 80 points, 70 points now.
We have been respecting the range of 18,000 on the way down to 18,350. That's acting as a bit of a resistance for our markets on the way up.
Nifty is up 26 points.
Bulk of the action finished at 11 o'clock. I mean, that was the market. I mean, you had a gap up which got sold. There was a rebound. We end basically absolutely flat, 10-point change, 18,256.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in just 5 headlines. I'm Ekta Batra. Here are the top stories for the day. Sensex and the Nifty end with marginal gains after a range-bound session. The Nifty Bank ends at a record closing high. PSU banks continue their gaining momentum. Vedanta approves a hefty 6,500 crores as dividend to its parent and minority shareholders, while Adani Enterprises may consider a large fundraise at its board meet on the 25th of November. Both stocks close in the red. TRAI's new tariff order effective Feb 1st brings relief to broadcasters on bouquet prices. The new regime allows for a higher cap and steeper discount to a la carte rates than earlier proposed. The entertainment gains in trade on the back of the news. Max Financial falls to a 52-week low after a sale of pledged shares by a lender trustee. Meanwhile, Nykaa's woes continue with the stock falling 2% after the CFO exits. DCW closes 3% in the green after news of the company planning to double its CPVC capacity and augment the capacity utilization of its plant to 100%. Inox Green Energy makes a subdued debut with stock lists at an 8% discount. All right, those were all of the top stories that we're tracking this evening. Here's a lineup of what we have in store for you. We bring you market opinion from Nilesh Shah of Envision Capital, and in Corporate Voices, we have with us Devansh Jain of Inox GFL Group. All right, so those were all of the top stories and what we have lined up. Let's start with the first headline and the market action today. It was a range-bound session on Dalal Street, which ended with marginal gains. The Sensex gained just under 100 points, and the Nifty gained over 20-odd points. The Nifty Bank, in fact, ended at a record closing high, which was one of the key highlights of today's trading session. Prashant Nair is here with a wrap.
It's becoming a bit of a feature with this market. For the bulk of the session, the market does nothing. Action right at open and action right at end. And today was no different. I mean, the market did what it had to do in the first 2 hours of trade. By 11 o'clock, the market went sideways. For the next many hours, it traded with a 40, 50-odd point change before coming alive again at 2:30. We saw a bit of a creep higher, and at 3 o'clock, starting 3 o'clock, there was a dump, and the market ended absolutely flat, just a 10-odd point change. Similar price action on the Nifty Bank as well. The Nifty Bank, although did a little better as compared to the Nifty. Mid caps and small caps ended about a quarter and a third of a percent higher in that range. Large cap gains and names like Apollo Hospitals, JSW Steel, HDFC Life, amongst others. Losses coming through in Adani Enterprises, Sports, Power Grid, and the like. Lots of sector-specific activity, right? Sector, subsector. So fertilizers is an area which saw a big boost. RCF, GNFC, GSFC, NFL, FACT. This is a new sector which has come into momentum today. The rail stocks are speeding ahead. RVNL, Ircon, RailTel, and they've had fabulous runs in this month so far, and the previous one as well. Broader gains, apart from these sectors, in RHIM, KPIT, NBCC, Hudco, a lot of these PSU, smaller PSU names coming into action. BKG was up about 10% by close. No such luck for the new age, newly listed companies, Paytm, Nykaa, Delivery, Policy Bazaar, all ending lower. Policy Bazaar, of course, came up a little bit, ending flat. So that's the market for you. As we kind of grind into the close of the year, you got to be wary of illiquid markets. And this is a feature which happens every year. Price moves seem exaggerated. In the very near term, you've got the FOMC minutes, which we get today. And tomorrow, you've got the US markets, which are shut because of Thanksgiving holiday, which will only add to illiquidity. The market did come off today. We'll come back tomorrow with, of course, cues from the US and the FOMC minutes to see if we can pick up where we left off.
Okay, well, let's get in some opinion on that note. Nilesh Shah, MD and CEO of Envision Capital, expects tech stocks to make a strong comeback over the next 2 to 3 quarters. He also discussed his take on new age stocks and the pharmaceutical space.
Believe that the lows that we've seen in 22, I don't think we're going to revisit those lows. What it looks like, I think, is from the kind of layoffs that we are seeing in the United States. Finally, the indirect fallout of that is going to be essentially a better environment for hiring, better environment for wage costs. That, in a way, will provide a strong cushion to the margins of IT companies. While growth for the next 3 to 4 quarters could still be on the lower side of the range, but I think that's probably going to be a more transient kind of a phase. And maybe 2 or 3 quarters from now, you will see again, IT come back very, very strongly. And I think the valuations are very, very attractive. So you're going to see a combination of growth coming back, margins coming back, and then, of course, valuations being attractive, perfect for growth investing. Fraud that we saw on pre-IPO or IPO or even post-listing, that is kind of completely gone out. What it looks like is that the valuations are attractive, especially for a long-term investor. I honestly don't know how these will behave over the next few quarters, but if you have maybe a 2 to 3 year kind of outlook, I wouldn't be surprised if these end up delivering some solid returns. Not all of them, but maybe just to select 1 or 2 out of them. Currently, in the very short term, the pressure from essentially the investors who came in the IPO or pre-IPO, I think that pressure will continue because they all need to book some profits or whatever profits are left out there for them by the year end. It's probably been the most disappointing kind of sector in terms of performance, especially from if we were to kind of look at the COVID environment and where we all thought that over the next few years, pharma is going to be a standout sector, and that has unfortunately not played out that way. And I don't see yet any kind of silver lining out there in terms of, the pricing. I think it's still a hope trade that, too much of the pricing erosion has happened and all of that. But I still think overhang in terms of pricing, in terms of regulatory stuff, in terms of margins, they still kind of continue to kind of be there. The reality is that there are, way many more number of other opportunities, many more other sectors which are today firing or at least are expected to do much, much better, especially on a risk-adjusted basis. So I'm not too sure whether pharma, it's not gone anywhere, but I don't think it will go anywhere.
Okay, well, on to the second headline this evening. Vedanta has approved its third interim dividend of 6,500 crores to its parent and minority shareholders. The record date for this will be Wednesday next week. Nigel D'Souza is standing by with the details on this story. Nigel.
Vedanta declared the third interim dividend to the tune of around 17 rupees and 50 paise. The total payout will be closer to around 6,500 crores. The parent entity holds nearly around 70% stake in the company, so they'll receive bulk of that dividend. Now, keep in mind the record date has been fixed as November 30th itself. The total dividend that they've declared in this year itself is around 68 rupees and 58 paise. The problem is that they're paying out more than what they're receiving even from Hindustan Zinc. And the net debt was around 32,000 crores odd. That's likely to inch up. We'll also be waiting for clarity in terms of what does the promoter entity want to do with this money, because most of the debt obligations are already satisfied. Citi, they have a sell rating on the stock, the target price of around 235 rupees. They say that Vedanta has paid out dividends in excess of around 3 billion, but they've received around 1.2 billion from Hindustan Zinc. The dividend that they've paid is more than what they were estimating. However, they say that the commodity cycle could be a little bit brittle or could slow down a little bit. In that event, things may not look very good. They also highlight the fact that demand for aluminium as well as zinc is a tad bit muted, and the commissioning of its captive coal projects as well has been delayed. Put all this together, Citi maintains the sell on the stock.
Okay, all right, Nigel, thanks very much for that. Well, sticking with big moves that took place, Adani Enterprises may consider a large fundraise at its board meet on the 25th of November. Reports say that the amount raised could be in the range of 1.8 to 2.4 billion dollars. Vivek Iyer has more details on this possible deal.
Well, the stock in focus was definitely Adani Enterprises. The company has informed the exchanges that a board meeting is going to be held on November 25th, 2022. And this meeting is mainly to consider and approve fundraising proposals as far as Adani Ent is concerned. Now, this particular fundraise could either be via the FPO, that is the further public offering, or it could be via a QIP route as well. It will be interesting to see, what is the exact route by which the company manages to raise funds. Now, when you're talking about, what exactly are newspaper reports indicating, newspaper reports are indicating that the size of this particular fundraise could be quite large. It could be in the range between 1.8 to $2.4 billion. And interestingly, if you look at the shareholding pattern, the promoter and the promoter entities own over 72% stake in the company. So it'll be interesting to see if it is indeed via the QIP route, what is the dilution and what is the exact quantum of funds that the company manages to garner.
Okay, all right, Vivek. Thanks very much for that. So that's on Adani Enterprises. But let's move to the third story today. TRAI's new tariff order effective Feb 1st has brought relief to broadcasters on their bouquet prices. The new regime allows for a higher cap and steeper discount to a la carte rates than proposed earlier. Analysts see this as a positive. Zee Entertainment gained in trade on the back of this news. Vedanta is here standing by with a wrap on the new rules and the stock impact.
Well, TRAI has made some amendments to the new tariff order 2.0 yesterday, wherein they say that as per the earlier new tariff order 2.0 version, the pricing on channels forming a part of the bouquet were capped at 12 rupees, which has now been changed and revised to 19 rupees. Also, as per the earlier new tariff order 2.0 version, there was a capping on the discount of 33% for bouquet prices, but as per the new NTO 2.0, the broadcasters are now allowed to offer 45% discount. So that is a benefit. Also, we have to wait for the implementation of this new tariff order, which is down the line and it's another 2 months to go. Also, the channel pricing list, which is required to be submitted on the 1st of Jan 2023. Nuvama feels that NTO 2.0 implementation is positive for all the broadcasters and they expect a good recovery in the advertising revenue for broadcasters due to the gross margins which are improving for the consumer companies. So net seems positive for all the broadcasters as subscription revenues now have the potential to increase in an environment which already has a subdued advertising revenues. Back to you.
Okay, all right, Vedanta. Thanks very much for that. Time for a break now, but stay tuned. We'll be back in a jiffy with all of the other top stories. Welcome back. You're still with us on Markets Today. Let's get to the rest of the stories that we're tracking for you this evening. Well, on to the fourth headline today. Shares of Max Finance Services fell to a fresh 52-week low after 1.55% of the company's equity exchanged hands in a single large trade. About 54 lakh shares of the company were exchanged at 649 rupees a piece. According to data available, the transaction size was worth around 347 crores. Well, moving on, Nykaa ended the day over 2% lower after the Chief Financial Officer Arvind Agarwal resigned from his position. This is the third big exit from the company in recent months. Manglam Malu is following the story. He joins in with the details.
Well, when it rains bad news, it really pours, and that's what's taken place in a lot of these new age companies, and Nykaa is one of them as well, where the last bad news that came in was yesterday evening, where the CFO Arvind Agarwal has tendered his resignation with effect from November 25th. While, the release says that he'll be pursuing opportunities in the digital startup space, it is not the first big exit. In fact, in the last 3 months or 4 months itself, we've seen 2 big exits as well, and this is the third big exit in the recent past itself. On November 1st itself, we had the exit of the CTO, Sanjay Suri, and in August, we had the CEO of FSN Brands, which is the private label of the company, Reena Chhabra, resigning as well. And both these people were with the company for almost 6 odd years. And this doesn't bode well for the stock at a time when it's down 50% this year, down 60% from its post-listing high. And that's not all. We've seen a massive sell-off in all these stocks, and Nykaa in particular, as the bonus shares were credited to accounts. And it wasn't just individuals or, HNI selling these stocks. It was actually a fair amount of funds as well who held in from pre-IPO, the kinds of TPG, Lighthouse, all of them selling. So massive delivery volumes on the downside. When everything's not going good, a resignation does not bode well.
Okay, all right, Manglam. Thanks very much for that. Well, very close to its fresh 52-week low for Nykaa. But let's move on to the fifth story today then. DCW gained 3% after it announced expansion plans. The specialty chemicals company intends to double its CPVC capacity and also plans to augment the capacity utilization of its SIOP plant to 100%. The company will be investing 125 crores for this particular expansion. Well, moving on, Inox Green Energy made a subdued debut on Dalal Street. The stock listed at an 8% discount at 60 rupees per share versus an issue price of 65 rupees per share. Vivek is here with the details on the listing and key takeaways from what the management had to say to us earlier today.
Well, absolutely. It's been quite a muted start as far as Inox Green Energy is concerned. And, not very surprisingly, given the fact that, even the grey market premium was indicated a slightly muted debut. But let's have a look at, what exactly the company does and what is it that they were intending to do via the IPO. The main reason the company went in for an IPO was, twofold. Inox Wind, the parent company, actually had quite a bit of debt. So to pare down the debt on that front and also to pare down its own debt. So 740 crore via the IPO route, a fresh issue of 370 and OFS of 370. The OFS route or the OFS proceeds went to Inox Wind, who will use it to pay their debt, and the fresh issue proceeds also used to pay debt as far as Inox Green Energy Services is concerned. Now, talking about Inox Green Energy Services, the company is part of the Inox GFL group. So 3 companies listed from this particular group. So you're talking about Gujarat Fluorochem, you're talking about Inox Wind, and also talking about Inox Green Energy Services. And when you're talking about what the company does, the company majorly is a wind power, operation and maintenance service provider. So O&M services for most of the customers that Inox Wind already has on its books. So how is it that you track the company? You look at the order book of Inox Wind, and that is a key indicator for, the prospects of Inox Green Energy going forward. The management, did come on our channel. They said that one of the key reasons for the IPO was to pare down debt, and they're quite aggressive in terms of wanting to further pare down the debt. They believe at the end of this particular fiscal, with some stake sales in SPVs as well, they should be debt-free and hope to turn profitable by next year.
We've got about 790 crores of debt as of 31st March 2022. 370 is going to get repaid by the primary proceeds of the IPO. What that would leave us with is approximately 420. Over the course of the year, we've sold 4 SPVs, 3 to Adani and 1 to Torrent. We've recovered majority of the 100 odd crores which was to be recovered there. What is left for us to now action out is sale of the last SPV, which would be downsold in the near future for about 300 odd crores. So broadly, what we're aiming for is to make this company a net debt-free entity in the very near future.
Okay, well, let's move on to a CNBC-TV18 exclusive. Poonawalla Fincorp may put its housing finance business on the block. Sources suggest that the ask price is 3 times the net worth of the arm, which was reported as 1,100 crores in September this year. Nisha Podar is here with the exclusive details on this story.
Thanks so much. Yes, never a dull moment when it comes to this company, it seems, because Magma Fincorp, the erstwhile name of this particular company, Poonawalla Fincorp, was, remember, acquired in Feb 2021 by other Poonawalla. And now we gather from sources with direct knowledge, and at least 3 independent sources have confirmed to CNBC-TV18 that Poonawalla Fincorp is looking at selling its housing finance business, which is a 100% subsidiary of the company. We do gather from sources that the valuation expectation of the seller is about 3 times of the net worth of the housing finance arm, which, remember, had reported 1,100 roundabout crores of net worth in September end quarter. Now, we do gather that a select group of private equity firms, and some may be strategic, also are the ones which have been chosen by the investment banking firm which has been hired to take forward this deal process. When we reached out to the company, Poonawalla Fincorp did state that our intention was to raise some growth capital in the company, for which they had announced in May 2022 about up to 15% minority stake sale. In the event of that, really, that breakthrough not happening for the company, and it's a cash guzzling business, they have opened it to a controlled sale deal as well, is what we gather from sources with direct knowledge. And now it is to be seen that which are the private equity firms which could be really interested, because we have seen a huge momentum in control deal from the private equity firms in the past.
Okay, all right, Nisha, thanks very much for that. So that's on Poonawalla Fincorp. Well, shifting focus to the banking sector, many large private banks seem to be following an old school method of boosting growth of opening branches during the last few quarters. Abhishek Kothari is here to break this trend down for us.
Now, one of the key trends that I've noticed over the last few quarters is that private banks in India are going old school, at least the large ones. This is a reference to them opening up branches in the last few quarters at a time when digitization is getting a lot of ground. So these large banks have also been growing faster than the industry's growth rate over the last couple of quarters, with focus especially being on the retail loan growth. So in last 5 quarters, HDFC Bank has opened 846 branches, a growth of about 14.3%. ICICI Bank has opened about 346 branches, a growth of 6.4%. Axis Bank has opened 160 branches, a growth of 1.7%, while Kotak Bank has opened 98 branches, a growth of 5.4%. When you open branches, you tend to gain on deposits, and it also aids in loan growth going ahead. Hence, the business momentum increase with branch expansion actually takes place. So from Q1 FY22 to Q2 FY23, the business per branch has grown by 5.9% for SDFC Bank, 9.4% for ICICI Bank, and Axis Bank and Kotak Bank around the 11.5% mark. Hence, branch expansion has worked the most in terms of business momentum for Kotak Bank and Axis Bank. The best part of branch expansion, or the sweet part, is to gain the low-cost deposits, especially when you open a new branch. The liquidity that comes in right now has become tighter and expensive. So the focus would be on the CASA, or the low-cost deposits called current account and saving account. The growth in CASA per branch has been led by Axis Bank, ICICI Bank and SDFC Bank. The Kotak Bank is the only bank to witness a decline in CASA per branch over the last few quarters. Branch expansion always comes with a cost. SDFC Bank, despite having the highest number of branch openings, has seen the lowest rise in cost per branch. So between Q1 FY22 to Q2 FY23, the operating cost per branch has risen by about 19.6% for SDFC Bank, about 26.9% for ICICI Bank, 29% for Axis Bank, and about 36.7% for Kotak Bank. So SDFC Bank has been the most cost effective with respect to branch openings, while Kotak Bank has been the worst. So branch expansion also aids in loan growth, especially in the retail segment. Now, market share has risen massively for SDFC Bank. Over the last 5 quarters, if you take a look, the market share gain is about 113 basis points for SDFC Bank, 62 basis points for ICICI Bank, about 32 basis points for Kotak Mahindra Bank, and only 12 basis points for Axis Bank. So despite digital transactions increasing, private banks' focus on branch expansion may seem to be a surprise. The opening up of branches also aids in market share gains as banks draw more customers, especially away from the NBFCs. The recent push for deposits by PSU banks do suggest that private banks have seen this coming. With liquidity crunch and banks focused on loan growth, branch expansion will aid in business momentum going ahead.
Okay, all right, Abhishek, thanks very much for that. On that note, it's a wrap on this edition of Markets Today. Thanks very much for watching.